various corporates to raise finances or to go for capital of the excuse me that wrong slide so okay. So we'll talk about this session on capital restructuring today. Why this the need of capital restructuring? See, the of late the world has been witnessing huge and tumultuous and tectonic changes in the various geopolitics as well as the various demographics of the workplace. So these changes in the geopolitics and the changes in the demography is having an impact on the various personal, social, and family and cultural values of people, and the consumers' taste are also changing very rapidly. So when the needs and requirements and tastes of consumer change, now the business organization will have to adapt to that particular change to be able to be competitive in the market scenario. So that is why the business complexities, they have also increased to keep pace with these changing customer taste. They have become really complex, and the global business scenarios, they are becoming much more volatile, and they are competing with each other, resulting in increased competition and very competitive environment. The issue is to deal with this kind of this rapidly changing scenario could be an opportunity or could be a threat, depending on how we are perceiving it and how we are able to accommodate it. We can use these scenarios to enhance the shareholders' wealth, to by the business enterprises. What they are doing is, they are across the globe, they are engaging in various restructuring of organizations, and forging business alliances with various partners to convert these kind of scenarios, that the so-called threats, into opportunities. Now, if you look at the kind of restructuring that is being undergoing, it's been we can talk about a corporate restructuring. Now, what is the essence of corporate restructuring is that, suppose an organization is not able to efficiently manage its own assets. So if you redesign the system, then probably the organization can be better efficient at utilizing the resources. So the restructuring becomes an important tool for the increasing the farm value, and the allocation of resources in such a way that they will lead to the efficient utilization of these resources. Now, when managers of one particular organization, they fail to use these assets available and the capital that is available in the organization, and to be able to derive the maximum financial and operational output of them, the best way is to restructure them or to transfer them to various other owners or managers who can probably do a better job with these assets and resources. Now, the basic purpose of this financial restructuring is to gain efficiency and to increase your overall value. How can you do it? You can do it by pooling of resources of different organizations, or probably by separating assets within a particular market, so that you exploit the potential synergies. So you can have either a concentration strategy where you pool the resources, or you can divest the assets and separate the assets. So you can have either of these strategies. Now, this corporate value can also be enhanced if by looking at the change in the capital structure of a company. So when we talk about the corporate restructuring, basically it can be done at various levels. Now the corporate restructuring is basically a process that that redefines the basic line of business, and it discovers a common thread for the firm's existence and consolidation. So the restructuring is basically is a process in which the company will attempt to alter what it has been doing in the past, and adopt a new system so that it can have the focus on the specific task and performance that are core to the company, and remove the assets which are not to the core of the business of the company. So they basically you change the method how you were doing in the what were you doing in the past to a new method of operating. So this is called the restructuring part. Now what we can do in the restructuring, it could be a radical process, it could be a gradual process as well. You alter a farm's, you can do so many things like altering a farm's product mix. You can change the capital structure of the farm, you can change the asset mix of the farm, you can also change the organization as a whole. So all these things are aimed to ensure that the value of the farm increases and you have some kind of a competitive edge, and that is on a sustainable basis. So we're not looking at the short term benefits through the restructuring, we're basically looking at the sustainable competitiveness and sustainable profitability. Now the the management usually it talks about the type of business, they will decide this is the core of our business. For example, if you talk about a hospital, the core business of a hospital is to deliver good patient services, that means good health care. So the other things are fringe. For operating a canteen within a hospital, that is not the core business of the, or for example let us say, let us say the beautification of the corporate of the campus of the hospital, that is not the core business. Now the core business is good quality of doctors and delivering good health care. Similarly, if you look at an institute, the core of the academic institute, so the core business of an academic institute is to deliver good quality of teaching and research. So all other things are non-core businesses. So the company will specify what type of business is the core business, and so that they can do it effectively. For example, if you talk about a company which manufactures aluminium, that is the core business. So the business and the market areas which offer no potential, they have to be removed from the business structure. So an organization can have so many things. For example, a hospital can operate a canteen on their own, but that is going to take up the resources. So the hospital might do one thing, that is outsource the canteen to some other party who will not take the botheration of running the canteen within a hospital. So these kind of activities have to be removed from the business structure. And any other activity, if that is giving you not so satisfactory returns, and it has its competitiveness as is not at par with the players in the other players in the industry, the management incapabilities, like the not so well performing director and all that, this should be discontinued in a corporate restructuring. Now, why we go for corporate restructuring? There could be several motives why we go for corporate restructuring. You can talk about the first motive of the restructuring is this government policy of this liberalization, privatization, and globalization. This has led the many Indian organizations to restructure their product mix, market and technologies, etc. So to meet the competitive challenges in the terms of cost, quality and delivery. Now, for example, if you have this revolution in the information technology, now it has facilitated many organizations to change the field of communication or improvement of the corporate performance. The best thing that we have seen is the how technology has impacted businesses is probably you can look at the payment systems, the digital payment systems, how it has how that scenario has been changed due to the information technology. You can talk about the new market and customer segment. So the if you can access the new markets and the new markets are coming up, the customers are changing the preferences, so based on that you need to go for the restructuring. You can have sometimes around diversification and divisionalization strategy that leads many organizations to revamp themselves. Now, the new businesses that were embraced by these organizations in the past, they proved not so successful, so they have to be dropped. And in order to do that, you need to restructure your organization. Similarly, you can talk about in product divisions that are not fitting into your core business. You have already acquired that, or you are experiencing that this particular division should not be in the organization, so then you need restructuring. If you're looking at improved productivity and cost reduction, you need to have a restructuring. Then if you have inefficient top management who are not able to take correct decisions at the time, then you can talk about this restructuring. Now, if you want to reorganize your financial structure for the improvement of your financial strength and the improvement of your operating performance, also you need to have restructuring. Now, when we talk about the various aspects of restructuring, we can talk about these four aspects, that is the financial, technological, market, and organizational. So it is in what we talk about in the financial restructuring. Here we talk about the various decisions that are pertaining to the acquisition, to the merger of companies, to the divestiture of businesses, to the various leverage buyouts, capital recapitalization, reorganization of capital. All these things are looked at and the decisions that we take under the financial restructuring. In fact, today's class is only devoted to this financial restructuring part. You can also have this technological restructuring, where the various decisions regarding the redesigning of business processes and with the use of newer and new technologies available, that is done. Now, when we talk about the market restructuring, basically market positioning, the which are the markets you have to penetrate, which are the markets from which you will withdraw, all these kind of decisions are taken in the market restructuring. And obviously in organizational restructuring, so you do what is you regroup existing business into new compact business units. So change the entire way the business is organized around a particular theme. The decentralization, the downsizing, the outsourcing of the non-value adding activities, the subcontracting, all these things are taken care of in the organizational restructuring. Downsizing, as you all know, so when we talk about organizational restructuring, it's basically changing the entire structure of the organization around a particular theme. So you redesign everything. So that will require, sometimes it will require hiring of skilled manpower. Sometimes it will require you to reduce manpower at your end. So you need to resort downsizing. So these are the methods how we can go for the restructuring. So we'll be focusing basically on the financial restructuring part here. Now you see, when we talk about the financial restructuring, now what is this financial restructuring? It is the process of basically reorganizing the company by doing what? By effecting changes in the ownership pattern or the asset mix. When I talk about asset mix, basically I'm looking at a pattern of the long-term and short-term sources of, short-term asset. Now the various operations the changes into these things is known as the financial restructuring. Now, what can we do under financial restructuring? We can talk about the mergers and takeovers, the LBOs, the spin-offs, the carve-outs. Now, all these things can be discussed in case of financial restructuring. Now, you see, we'll start with the discussion, a preliminary discussion on the merger and acquisition. Merger and takeover. So, the company that is intending to acquire, suppose the basic concept of this financial restructure through merger and acquisition is that you two companies come together. What are the modalities of coming together? Either it is taken over by a company or they're merged, depending on these two. The nature of the coming together of two companies, the it can take the shape of a merger or can take the shape of a takeover. Now, if a company is intending to acquire another company, maybe it can buy the assets of the company or buy the stocks of the company. Okay, so basically, when we're talking about taking over, you can either buy the assets or buy the stocks, or basically merge with the latter. So when we acquire a company, you can either take the route of merger or you can take the route of the takeover. Now, what is a merger? The merger is where the two companies they merge into a single entity, and only one survives and the other loses its identity. Sometimes what happens is when we are merging, two companies they merge. Let us say X and Y. X is a company, Y is a company, and they are merging. It might, so three things might happen. Okay, number one, X will remain, Y will lose its identity, Y will remain, X will lose its identity, or they will merge and form a new identity that is called XY. Okay, so neither X will exist nor Y will survive. Both of them will lose their identity, and a new company called XY will be born. So this is called the merger. Now it is a company. It's a company. Now when we're talking about one company survives and the other one loses its identity, we call that as absorption. Merger through absorption. Now when both the companies they lose their identity and a new company takes shape, we call that as an amalgamation. So merger through absorption and merger through amalgamation. Now you can talk about the surviving company will take over the both the assets as well as the liabilities of a company, be it absorption, like either X surviving or Y surviving, then X will take up both the assets and liabilities of Y. Even if we are forming a new company called XY, XY will take up all the assets and liabilities of both the companies of X and Y independently. Now, what is a takeover? Now, takeover is basically the purchase of a company, the controlling interest of a company. So, how can you do it? How can you purchase a controlling interest? By buying shares. So, you buy shares in the either in the open market or from other shareholders. So, there are various methods of takeover. So, you buy the shares of a company. If you buy more than 50% shares of a company, you have the controlling right. Then you have taken over a company. Now, what happens in takeover? Both the companies they retain their separate legal identity. Okay, so one company, it is not that one company will lose its identity and the other will not, but both the companies will continue to remain a separate legal entity. Now, when can we go for takeover? It is when you are trying to gain control over a company. While companies are amalgamated to derive advantages of the scale of operations, achieve rapid growth and expansion, and when you are trying to build strong managerial and technological competence, you can go for these takeovers. Now, in India, there are many takeover specialists. The takeover kings, we call them, like Mr. R.P. Goenka, Mr. Kumar Mangalam Birla, the London-based businessman Mr. Suraj Paul. We know them as the takeover kings. So you talk about now the merger. Now we'll come back to merger. The merger could be of different types. Now they can be affected in different forms. Now it could be horizontal, vertical, conglomerate, market extension, product extension, or reverse. Now we'll just discuss briefly about each of them. Now the horizontal merger is one that will take place between two firms which are in the same line of business, okay, and at the same level. So this type of merger, what will do, it will create some significant impact on the market if the merged entity is going to have a significant market share. Okay, now for example, let us say the merger of Hindustan Lever with the Tomco, let us say the merger of Vodafone with the Idea Cellular. These are the examples of vertical, I mean horizontal merger. So two telecom companies which are operating, which were competitor of each other, and they're operating in the same business and the same level. When they come together to form a new company, or they merge to become another company, so that is called a horizontal merger. The cases I have just given you. Similarly, if you look at the next item, there is a vertical merger. A vertical merger takes place, as the name indicates, which are in the between companies which are in the successive stages of the same industry when they are integrated. For example, one is a manufacturing industry, the other one is a raw material supplier. So when these two come together, it is called as a vertical merger. So you can call the merger to be a backward one or to be a forward one, or the both ways. Now, basically, a backward vertical merger basically moves towards the source of raw material. So, when let us say, for example, the merger of the Hindalco, which is producing aluminium, with the supplier of the ore, that is Renusagar power supply, when they merge, this is the example of a backward vertical merger. Now, forward vertical merger basically refers to moving closer to the ultimate customer. So that means you are coming forward from the manufacturing to the distribution. So, like for example, DuPont, when it opened a series of stores, or for example, if Reliance Petrochemical, it opens up petroleum stations across, that is the example of a vertical integration or vertical merger. So you are coming closer to the customer in the forward merger, and in the backward merger, you are going away from the customer and towards the source of the raw material. So these are the two vertical mergers. You can have a conglomerate merger. In a conglomerate merger, it's a basically fusion of two unrelated business lines. Okay, they may be completely different from each other. So why the companies undertake this kind of a merger is that these mergers are done to basically diversify the existing business of companies. Now, for example, you can have a pure conglomerate merger, you can have a mixed conglomerate merger. Now, a pure conglomerate merger is one where the totally different identities they are merging with each other. For example, let us say the merger of Brook Bond Lip. I mean, let us say when we talk about the merger of okay, the merger of the Brook Bond with the Hindustan Lever. So Brook Bond was in the food segment, and the Hindustan Lever was, at the time of merger, it was basically the FMCG product. So that kind of a merger is a pure conglomerate merger. Now, when we talk about a mixed conglomerate merger, these are the companies which are aiming to expand product lines or the target market. For example, if when you are talking about the Thomas Cook merging with the Sterling Holiday Resort in India, so one is in the tourism industry, other one is the leisure industry. So basically, that can be called as a mixed conglomerate merger. Now you talk about the market extension merger. This is a merger where the companies that sell the same product or services but operate in different market, they come together. This is known as a market. The market extension. For example, the Arcelor and Mittal, the merger between these two companies is example of market merger, because you are Arcelor was catering to the European market, and the Mittal was catering to a different South Asian market. So when you come together, you are basically extending your market across the globe. So it is a product extension merger. Whereas when we talk about market extension. When we talk about a product extension merger, it will happen between companies that sell related product or services operating in the same market. For example, if the tie-up or the merger, if it happens between Pizza Hut and PepsiCo, then probably you can call it as a product merger, because it is operating in the same segment, those who eat out. but different product. For example, a pizza as well as a soft drink. So that's a product extension merger. Then you have a reverse merger. Now, this kind of merger happens to basically take advantage of the tax savings under the Income Tax Act. Now, one healthy and profitable company, it is allowed to it is allowed the benefits of carry forward losses when merged with a sick company. So, the Godrej soaps, which merged with the loss-making Godrej innovative chemical, is an example of a reverse merger. This takes place to take advantage of the loss on the one company. The benefits will be transferred from one company to other company through this kind of a merger. Now, what could be the various motives for merger? Now, you can talk about to avail the operating economies. Now, if two companies are coming together and they have they derive operating economies in terms of they can eliminate the duplicate facilities, you can reduce the cost, you can increase the efficiency because you are now having operating with the same set of people, so the utilization of people is maximum. Now the operating economies of staff level can also be achieved through centralization. So basically the first motive is the operating economies. Then you can talk about we want to achieve faster growth of your company. So if you do vertical and horizontal integration, I mean merger through various companies, then you can grow very fast. So you can do it to take advantage of the complementary resources. Now suppose for example, let us say the merger opens up opportunity where company X and company Y, they are not independently able to pursue something, but when they come together they can independently pursue something. So this kind of complement each other. So this kind of the motive could be there. Now speed up diversification. Suppose we are going for this horizontal diversification, I mean merger, then you are, because you are integrating with a different not horizontal, actually vertical, then you are going for diversification of your business, so, and reducing the risk. Now you can combat the competitive threat that you can do through, let us say, the fear of increasing competitiveness that results in companies basically joining hands and coming together to, so, let us say there is in the laptop industry there is a huge competition among this small number of players available. Now if it is difficult to individually survive the competition, but if one or two companies they come together and become a big company, then it is easier for them to dominate the market. So the competitive threat is a big motive for the merger. You can do that to access the technology. Now for example, the Tata Telecom tie up with the AT&T, the Maruti Suzuki alliance, all these things, they are examples of mergers which have taken place to have access to the technology. Now you can widen your market base through these mergers. You can strengthen your financial position because now you are having huge amount of resources and there are no duplicate activities, so you can do that. You can avail tax shield. Just now I said that in reverse merger, one company has poor operations, so it can get some tax rebate. The other company has good return, but it is not able to get the tax rebate. So if it combines with these two company combine, you can take the advantage of the tax rebate as well as enjoy the handsome returns. If you have some surplus fund, you can utilize that to when you talk about a merger in growing the size of the business. Now the mature industry, they have generated several substantial amount of fund. Now you can use that fund to acquire new and fast growing companies to basically push your growth rate. Now you can acquire competent management. Now if you suppose your top management is not competent enough to deal with the issues faced by the company, then you can merge and you can change the top management and you can have a competent management in place. So also to, like we talked about the takeover, to strengthen your controlling power through the acquisition of shares and voting rights. You can get the controlling position of a company, so that is also a motive for your merger. Now the point is, how do we assess if this merger is adding value to our company or not? Now, to assess that, we can talk about something called the value addition. That is what we're deriving from a merger. Now, the how to know whether the merging of a company is going to be beneficial for me or not? So you can look at this particular figure called economic gain from a merger. Now, what is this meaning of economic gain? Now, for example, X is a company, Y is a company, and when X and Y come together and form XY, then is the value of this new entity bigger than the combined value of the two independent firms like X and Y? That is what we are looking at. Now, if it is so, then we have got value addition in the merger. Now, how do we define that economic gain? The economic gain is defined as the present value of the firm XY minus the present value of the two independent firms bundled together. Okay. Now, suppose X is going to acquire Y. So in that case, X needs to pay some amount of money. Suppose it is acquiring the assets or the shares. So the company X has to pay some amount of cash to company Y. So what is the cost of acquiring Y? You can say the amount of cash that we have spent minus the value of Y. That is the cost. For example, the value of company Y is 10 lakh, and you have paid 12 lakh to acquire that particular company. So the cost of this merger to you is the cash you have paid 12 lakh minus the value of the company 10 lakh. So the cost to you is 2 lakh. Now, once we get that cost of acquiring firm, we can now find out the NPV, the value addition that we are achieving in a merger. Now, the NPV can be defined as the gain, or this economic gain that we talked about in the beginning, this gain minus the cost. So here the difference is the whatever is the gain in the first step we calculated minus the cost in the second step calculated 2 lakh. So that is the change in your in the economic value. So if this particular difference, gain minus cost, if it is positive, it is advisable to go ahead with the merger. If it is negative, then you don't, that means cost is higher than the gain, then you should abandon this particular proposal of merger. Now, if you look at an example of this thing, suppose firm X has a value of 400 crore and firm Y has a value of 100 crore. Now, merging the two companies into X and Y will allow the cost savings with the present value of rupees 50 crore. So basically, the PV of X is 400 crore. The PV of Y before the merger took place is 100 crore. Now, here the gain or the del of present value of XY is, as it is mentioned in the question, that is 50 crore. So basically, the present value of this particular company is the total taken together, that is 400 plus 100, that is 500 crore, plus the delta value, that is the 50 crore. So the value of the new company XY turns out to be 550 crore. Now suppose firm X paid an amount of 130 crore to buy the firm Y. So then the cost of the merger is going to be the cash that you have paid 120 crore minus the value of the Y, which is mentioned in the question, that is 100 crore. So 130 minus 100, that is 30 crore is the cost of this particular merger proposal. Now we have got three things. Number one, the economic gain 50 crore. The present value or the value of the new entity, that is 550 crore, and the cost of acquiring the project, which is the 30 crore. Now with this, if you look at the NPV, is basically the gain minus the cost. Here our net gain was 50 crore minus the cost is 30 crore. So this is 20 crore. The NPV is a 20 crore. 20 crore is a good amount, so positive amount. So we can go for this merger. If it would have been negative, then we could have rejected that. So basically, the farm X is worth in the beginning, that is 400 crore. Now after the merger, it what should be the value of this farm X? It should be, because out of this 50 crore, 20 crore belongs to the company X after merger. So the net gain to the X owner is basically the wealth with merger minus the wealth without merger. Okay. So the wealth with merger is 550 crore and the wealth without merger is 430 crore. So then it comes to 20 crore. Okay. Now, if you look at the various terms of the merger, now you see, when we are designing the terms of merger, the management of both the firms insist on something called an exchange ratio. Now, this is a scenario where we talked about the exchange of cash. Now, what happens if the investors of a company, instead of cash, they would like to have shares in exchange of the other companies of their own share? Now, the acquired farm or the farm X would therefore like that the price per share of the combined farm should be at least equal to the price of the farm X. Now, for example, suppose my farm's share price currently in the marketplace is, let us say, 300 rupee. Now my company is being taken over or is being merged with another company. So I would want that even after merger, the new company's share price should be more than 300 or should be at least 300. So because I want that it should be more, or at least if it is low, it is should not be lower than my share price. Now, so when we talk about these the various terms of merger, we can look at some of the calculation part. You see, the when we talk about the share price, now the share price of the entity, new entity P of XY, subscript XY, this has to be, as we said, has to be minimum of the price of the X company. So the PXY has to be PX, and the market price, what is PXY, is the market price of the new entity. What is PX is the market price of the entity which has been taken over or which has been merged. Now you see, the price of any company share is can be derived by multiplying the PE ratio, price earning ratio, with the earning per share. So if you do the price earning ratio of the XY company with the earning per share of XY company, you get the price of XY, which is also equivalent to price of X. Now the earning per share of the combined farm of PXY, the combined farm, how we can get it? We can get it by combining the total earnings. So EPS is nothing but the net profit divided by, or the earnings, net earnings divided by the number of shares. Now, what is the net earning? Net earning is the earning of X and earning of Y. So we don't have any third party from which the earning will come. So the earning of X is EX, earning of Y is EY. That is a numerator. Now, as I said, EPS is earning divided by number of shares divided by, now we'll talk about a number of shares. Now, X is taking over Y. So the point is X, the shares of X will remain and the shares of Y will now change into shares of X, because Y is going to lose its identity. So the when we are merging through the exchange of shares, so I will come up with a share exchange ratio wherein one share of X will get those, when suppose one share of X ends up getting two shares of one share of Y, or three shares of Y end up getting, if you have three shares of Y, you can get one share of X. So then you have an exchange ratio which is close to 33%. Okay, if two shares of Y are needed to get one share of X, then you can talk about exchange ratio of 50%. So here, if you multiply the exchange ratio with the number of shares of X of Y, then you get the number of shares actually there in the new entity, that is number of shares of X and number of shares of Y multiplied with the exchange rate with the X. Now, if you using these two equations, now we can rewrite the equation 2 as the price, what should be the minimum price of X company share? It is the price earning ratio of the new entity into the EPS of the new entity, and the EPS has been derived through this particular formulation. Okay, so the price of the merged entity is dependent on the price of the new entity. Now if you solve for this exchange ratio from this equation 4, if you solve for this exchange ratio, which is in the right hand side of the equation, if you solve for of the X company, then that's a involved calculation, so we'll skip that. So the exchange ratio of X will be minus Sx divided by Sy, that is the number of shares, plus the earnings of both these companies multiplied with the price earning ratio and divided by the market capitalization of the old company, of the merged company. Now if you look at this, we can go through the simple example. Now X corporation is contemplating to acquire Y. Now the financial information is available regarding this, like 10 lakh and 4 lakh shares you have. Number of earnings are 10 lakh and 4 lakh. The number of shares are 5 lakh and 2 lakh. The market price of share of P is share price P of X is 6 rupee, and this is 4 rupee. So you have to determine the maximum exchange ratio. So if you look at the maximum exchange ratio using the formula, the exchange ratio of X is equal to minus X Sx by minus Sx by Sy. So basically number of shares of X, which was 5 lakh, and the number of shares of Y, which was 2 lakh, given in the question, plus the price earning ratio of XY is given as 3, and the earnings of XY taken together, earnings of X and earnings of Y here, earnings of X and Y, that is 14 lakh, is taken together, and the 3 into the PE, which is 3 into 14 lakh divided by the Px into Sy. So that has been done. So the exchange ratio, it comes out as 1, which means that one share of X can be replaced with the one share of Y. Okay, you can also similarly calculate the maximum exchange ratio from the shareholders of the firm X we have done. You can also do the minimum exchange ratio from the point of view of Y. So we need to slightly change the calculation, and we can develop a new formula wherein we can get the exchange ratio of Y, and we can put the plug the various details into the equation and get the values. Now we come to the takeovers. Now the financial structuring via takeover, it generally implies that the acquisition of a certain block of equity share capital of a firm that will enable the company to exercise some kind of a control over the affairs of a company. Now it is not always necessary to buy 50. Usually we say that 50% is a controlling stake. Now but you don't need to buy actually 50% of the capital. So what you can do is you can come together, some of the investors can form cartels, like 4-5 investors can come together in the form of a cartel, and they can have 50% share among themselves. So a group of people can also attempt to take over a company if they have the controlling stake. Now, when we're talking about this, the merger and acquisition strategy, you can talk about the various merger and how do you formulate the various merger and acquisition strategy. So you can have a objective, lay down the objective and the criteria relating to your takeover. So the these all these criteria, they will sum up the acquisition requirement, including the type of organization to be acquired. So basically this is what you decide in the first one. Then you talk about the you assess the corporate competence. So you undertake a detailed study to find out the firm's own capabilities in making an acquisition proposal. So this kind of study, it should be done to be sure that your firm has the necessary competence to carry out this acquisition program very successfully. Then after having done these two things, you can locate the companies that you are looking to acquire by the, you can have several criteria. You can have the choice of a company. You can talk about the kind of diversification you want to achieve. You can also have a look at the market share that you're intending to achieve, the what is the size of the company that is going to buy, and what should be the size of the purchase, whether the company you're going to acquire, is it profitable or not. All these things will have to be discussed before you locate a company to acquire. Then you evaluate the prospective candidates for acquisition in terms of the economic gain and the cost, and the you study the general background of the various potential candidates, and the operations of the potential candidates are also studied before you formulate any M&A strategy. Now, the mergers and acquisitions, or the mergers and takeovers, they earlier they were governed by this Companies Act, the MRTP Act, the FERA Act, the Income Tax Act, and the CBI. Now, the currently it is the M&A activities are being governed by again the new Companies Act of 2013, the Competition Act, the Foreign Exchange, and the FERA has given way to the FEMA, that is Foreign Exchange Management Act, the Income Tax Act, and also the SEBI regulations. Okay, so these are the regulations that are applicable to the merger and acquisition here. Now, if a company is trying to take over your company, so what can you do? Now, the Companies Act, it will restrict, the 2013, it will restrict an individual or a group of people or a company to acquire shares in a public limited company to 25% of the total paid up capital. Okay, you cannot buy more than 25% on an individual basis. However, the control group needs to be informed whenever the holding exceeds 10%. So, which means that if an individual has already purchased 10% and he applies for buying new shares, it has to first be intimated to SEBI, and the SEBI will have to intimate that to the board of directors of the management of the company. So, the management knows that beyond 10%, who are the people who are showing interest in your company and they are increasing their stakes in your company. Now, the company or the group of individuals that acquire the share of another company in excess of the limit, it requires the approval of the shareholders and the government. So, if you are already having 10% and you are trying to buy another 2% and you have failed to intimate SEBI and failed to take the permission of the shareholders of the company, then that transaction could be termed null and void, and that purchase could be redacted. So you have to be very careful when you are purchasing beyond 10% limit. Now, there is a concept called a hostile takeover. In a hostile takeover, it will happen when an entity takes the control of a company without the knowledge and against the wishes of a company's management. Suppose I am running my company and and another company wants to take over my company without my consent, and that is called as a hostile takeover. Now, it is also an acquisition strategy that require the entity to acquire the minimum of 50% of the voting shares. And how do you do that? You can, by acquiring the shares of 50% shares of a company, you can get the 50% votes of the company. Now, this is not a good practice. It is not considered a good business etiquette. Now, the acquiring company can achieve a hostile takeover by going directly to the target company's shareholder, or fighting to replace its management. So, you can take over in a hostile manner. You can take over a company through these two routes. Now, even hostile takeovers might take place if a company believes that the target company is undervalued, and when the shareholders, they are not happy with the company because of the undervalued shares, so they can take over the company to satisfy the shareholders. Now, the tender offer and a proxy fight, these are the two methods of achieving a hostile takeover. Now, what are the various strategies that you can undertake to avoid these takeovers, hostile takeovers. You can talk about something like a poison pill, or you can talk about a golden parachute, or you can talk about a staggered board of directors. Now, these poison pills are basically shareholder rights plans. Or, for example, you basically what you do is the basic tactic here in a poison pill is to increase the number of existing shares. Suppose you already we're already having 10 lakh shares, out of which 10% or 25% is with a particular organization or person. Now you increase the number of shares. How can you do it? So if suppose now 10 lakh he was having 2.5 lakh, so he was controlling 25%. So you make your 10 lakh shares into, let us say, 20 lakh share. So he's if he doesn't get to buy the share, so he will be 2.5 lakh on 20 lakh shares. The 10% holding will now, I mean 25% holding will now drop to 12% holding. Now how can you increase the number of shares of a company? If you can do it, if you have issued convertible debentures or convertible preference shares, so convert them into equity, so that will increase the number of shares. Or for example, you go for the rights issue. In a rights I mean the shareholders rights plan, it will allow the company to issue new shares to the existing shareholders at a discount, so that you can also do that. So the poison pills could be delivered in many ways. Similarly, there is a strategy. There are so many strategies. I'm just discussing the more popular ones. You can have a golden parachute scheme where you can do it by incorporating the various termination agreements in the corporate bylaw of senior management personnel, where large portion of payment is given as a stock option. Okay, so when a person leaves, it is given. I mean, when a person joins as a appraisal or as a benefit to him, you can give him employee stock options. So, and there is a lock-in period in employee stock option. So he has to spend 3 years or 5 years with the company to be able to take the benefit of the employee stock options. It can be a very effective defense strategy. Now you can also talk about a staggered board of directors, where you don't appoint all the directors on a single date or in a single meeting. You can stagger the days, or you can have various levels of the board of directors. You classify the board, so that means all the directors they will have different tenures, and they will come in at different time and leave the organization at different time. So you can have that kind of a system wherein you can defend the takeover strategies. Now there could be several guidelines that are there in case of the takeovers. These guidelines could be available at the you can google it, and you can find out the various takeover guidelines are there. These keep on changing from the time to time. So this is a list of the guidelines that are there for the takeover. So you can like you have to inform the notify the stock exchange, what are the share acquisition, the public offer, the offer price, the disclosure. All these things will have to be followed as per the SEBI's guideline. Then we talk about the next restructuring method, that is the divestiture. Now see, while merger, acquisition and takeovers, they will lead to the expansion of business in some way, divestiture is basically contraction of the business. That means you reduce the size of your business. Now divestiture is also a form of restructuring, because you transfer the ownership of one particular plant or one particular division to someone else. That means you let go of a company to another party who will come in as a management of that particular company. For example, the Coromandel fertilizer the sale of the cement division by the Coromandel fertilizer to India Cements is the example of a divestiture. Now the Coromandel fertilizer wanted to focus on its own core business of fertilizers manufacturing, and did not want to deal with the cement division, so it sold the cement division to Indian Cements. So then the ownership is transferred to the new company. This is called a divestiture. That means you are reducing your size. Now, it is usually pursued by farms which are very highly diversified, and they have a difficulty in managing a very diversified business. So they drop some of the businesses and focus their attention on a limited number of core business activities. And by doing so, you can free up your several resources like human resources, financial resources. You can free up these kind of resources, and you can focus all these resources on the limited number of areas where you have expertise. So the divestiture is basically aimed at reducing size in order to achieve the operational efficiency. Now again, how can we assess the financial aspects of a divestiture? For example, the value of the ownership position with the proceeds from divestiture. Now the proceeds from divestiture is greater than the ownership position, then you sell the unit. Otherwise, you can hold on to the unit. We can also talk about another financial restructuring, which is the leveraged buyout. Now, leveraged buyout, it involves the acquisition of a division of a company or another subunit, and at the same time, it will also involve that you acquire an entire company. Now, because the entire acquisition or the large proportion of this acquisition is done by taking a debt, huge amount of debt. The debt is also known by the name of this leverage. So this kind of buyouts are known as the leveraged buyout. Now the debt is not intended to be a permanent debt. It is designed to be paid down through the operations of the acquired entity. Now the sale is to the management of the division of the being sold, and the leveraged buyout are usually cash purchases. So there are many prerequisites, essential elements involved for the success of buyout. Now, for example, you can have several year of window of opportunity. Now, cash flow must be dedicated to the debt service. So you buy a company, and for initial cash flows, you are not going to divert to anything else but to the service of the debt that you have taken to buy a particular company. So the company must be stable. It should have a stable and predictable operating cash flow. It should have sufficient physical asset. It should have competent and experienced management at the top. The other restructuring forms are like, one is a spin-off. Now, what is a spin-off? It is a restructuring method which involves the creation of a completely new independent company by detaching a part from the original or the old parent company's assets and operations. Now, the shares of this new company are distributed to the parent company stockholders. So there is a company called ABC, and from that you detach a part of the company's unit and make it into a new company, and the shares of that company will be issued to the shareholders of the parent company. So that is a form of restructuring which is known as a spin-off. Okay, now this when you spin off, you basically take care of the businesses which don't fit into your core competence, and you put up a different management in place of this spin-off company. So both the companies are now sufficiently efficient, and they can manage their own businesses. So the carve out is such a method where the is similar to a spin-off, with the exception that the shares in the new company are sold in public instead of distributing them among the existing shareholders. So spin-off and carve-outs are mostly similar. The only difference is the way you deal with the shares of the new company. In a spin-off, the shares come to the parent company, whereas in a carve-out, the shares go to the public in a public sale. Now, you can also reorganize the capital. Like when we're discussing the financial restructuring, we're talking about the reorganization of the capital also. Now, the reorganization of capital means you basically you attempt to reduce the total debt of a company, because if the debt is too high, it is becoming not so serviceable. So you have to reduce the fixed charges, because fixed charges take down the efficiency of the company. So how can you reduce the debt? You can reduce it by voluntarily extinguishing some of the debt instruments. You can do it by refunding. You can do it through redemption. You can also do it through the conversion of the convertible debt. So the financial reconstruction is also a part of the financial restructuring of an organization. Now, in a reconstruction, we recast the firm's capital structure to give you the perspective. If you look at this, now look at the snapshot of this company's balance sheet, where debentures were 18 lakh, subordinated debentures were 6 lakh, preferred stock 12 lakh, and the common equity was 20 lakh. So the total was 56 lakh. Now we want to recast this particular structure. So what we will do is we can we'll decide on the appropriate capital structure. Suppose we say that it is going to be 40 lakh. So we change the debt, the income, and the preferred stock. So basically we'll reduce all of these elements to go towards the targeted capital structure. Okay, so that is how we can financially reconstruct, and that is also a part of the corporate restructuring. So I guess we have come to the end of this discussion regarding the strategic financial restructuring part. Thank you.